queue.
Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat today. Well, the foreign flows are pulling back from equities, though remain strong into debt markets, into India as well as certain other EMs. Questions about which sectors exhibit strength in such choppy markets. And of course, more importantly, because that one sector has sulked quite strongly for the last few days or last few weeks or months, if you will, uh, financials, banks and NBFCs. What's the case and argument for strength here on, if at all? Our guest today, Mr. Mahesh Nandurkar of Jefferies. Mahesh, great having you. Thanks for taking the time out.
Thank you, Neeraj, and good to be back here.
Thank you so much. Pleasure is ours having you, Mahesh. The perfect storm, if you will. If last year we had one geopolitical issue, now we have two. Crude prices are higher, at least two, I might add. Crude prices are higher. And there is this whole talk of the higher yields and interest rates leading to refinance problems for a clutch of emerging market equities, maybe even in India. Uh, in such a case, what's the argument for the markets moving higher from here on, if at all? I'm not saying you have that argument. I'm trying to understand how you think about
Yeah, Neeraj, so, all the valid questions. I would say that the global situation in terms of, as you rightly mentioned, higher yields is perhaps the, only issue that I see for the global equity markets and that for the Indian equity markets as well. But most of the other factors are actually, I would say, quite supportive for the Indian equity market from a 12-month or whatever, 2-year, 3-year perspective. We have finally got into the investment upcycle or capex upcycle, if you will, after a long gap of nearly 10 odd years. That's usually a great sign for economic growth, for corporate earnings, and broadly speaking, for the risk appetite in the economy and therefore in the equity markets as well. The overall flows situation is aligning itself. The domestic flows have been pretty good for quite some time and continue to stay strong. The international flows, have been on and off, but relative to the rest of the emerging markets, India is looking sort of very good. So there's a relative case here. So several factors aligning for the markets to show a reasonably good performance from a 12-month and beyond. Near term, you're right. We are clearly seeing the headwinds in the form of higher oil prices, and it could probably have some impact, on India's inflation outlook as well. And we've seen one of the emerging market central banks, Indonesia particularly, surprising the markets recently with a rate hike. Although I don't really see that situation in India, as yet. Maybe we are also in for a that higher for longer kind of a situation for some time, which is there in the US and the other developed markets. And yes, and that is probably going to be a bit of a headwind for flows into the emerging markets, right? Because if the US bond yields are close to 5% or higher, and that kind of a situation is not really ideal for flows into the emerging markets. So that's a negative for, I would say, generally the equity markets in the emerging markets, and also therefore for India. And that's why we have been seeing the foreign flows have turned negative again for the last 2 months. But as I said, the positioning of the foreign investors in the Indian market is not as heavy as one might be thinking. And so to that extent, I do see a potential. I mean, any small window that might open up, we will likely see more FI inflows rather than outflows. And in the absence of that possibility, we are seeing strong domestic market, sorry, the strong domestic flows. So any dips in the market are likely to be short-lived. So we have seen one small correction over the last 1 month or so. From the recent peaks, we are down about 5% or so. Uh, Maybe another small correction cannot be ruled out in the near term, but I think it will continue to be a buy on dips market for us.
it. Right. Uh, the just trying to, and I know you would probably look at markets from, let's say, 1 year, 2 year, 3 years, but you also have this responsibility, I presume, of tactically making a call. I was just wondering, tactically, because of all the reasons that we outlined, plus the fact that there could be nervousness around elections too. I heard you use the term a small correction. Do you believe the probability of that is higher? And how small would this small be?
Yeah. So Neeraj, so we actually did take a cautious stance, a tactical cautious stance, about a month or so ago, and precisely for the reasons that you mentioned, the higher bond yields elsewhere in the world, and the inflation outlook, in India, the fiscal situation, as well, keeping in mind we're running into the election period, and there is a probability that there would be some reallocation of government expenditure from the capex side to maybe some of the social schemes at the margin. And even without the election, I would say, outlook in the near term, generally speaking, I believe that the government spend on infrastructure or government spend on capex as a share of GDP has peaked out. In my view, so over the next 2 to 3 years, as the government aims to reduce the fiscal deficit, I think it will have to come at the cost of capital investments. But that's fine because the government can afford to reduce the capital expenditure now because the private sector capex is showing a reasonably strong pickup. So there is a space for the government to take some corrective action there. But yeah, but coming back to your original question, the cautious the cautious stance. Yes, I think there is sort of a reason from a near-term perspective. We've seen a small correction, and as I said, maybe another similar 4 to 5% kind of a correction cannot be ruled out.
Okay.
Uh, but we would be, as I said, be buyers into that dip because so in fact, we've already raised some cash in our model portfolio. Anticipating that, and a part of that is already visible as we speak. And in if there were to be another similarly small correction, we would look to deploy that cash back in.
Mm. Your colleague Chris recently made a very interesting comment about the kind of corrective moves that could come in if the national election kind of goes the other way. Just your view on the state elections. Do you think that if the results are not in favor of the ruling party, could that be a trigger as well for the markets to get this 3, 4, 5% correction? Is there? I mean, do you make such prognosis, or is this not something that you indulge in?
No, the markets and the investors, I think the local as well as global investors definitely, ideally want to see the political continuity, and that's our base case. That's the most likely scenario in the national elections. In the upcoming state elections, well, we will wait and see. But we have seen historically as well that there has been large divergence between the outcomes of the state elections and the outcomes in the national elections, and the voters do tend to vote differently for state versus national. There are enough examples of that. In fact, if you remember back in 2000, before the 2019 elections, in December 2018, that is, the same 3 4 states went into poll, and we saw a very different outcome in those state polls versus the national polls as such. So yes, if the state polls were to go similar to what happened back in December 2018, I do see a probability of a near-term correction. So say around December, so that cannot be ruled out. But as I said, I think that will be the time to buy. If that were to happen.
Got it. Now, back in May, Mahesh, we culled out some of the opinion that you presented on different media, including ours as well. You were constructive on the start of the capex upcycle, favoring capital goods and engineering stocks. You had chosen bank financials over IT with a priority to housing finance companies, and uh, maybe NBFCs outperforming banks with a cut out there. Now, I'll ask you your follow-up thoughts as 3, 4 months have passed on each of these. So first, you referred to the capex upcycle twice in our conversation already. Is that the clear and present pivot around which a lot of themes and sectors would perform? And what would those be?
Oh, absolutely, Neeraj. That clearly remains one of our high conviction calls now. So you remember we turned quite constructive on the housing cycle a while ago, That has now played out reasonably well. We are in the third year, I would say, of the housing cycle upturn, and I clearly see several more years for that housing upcycle to continue. Now, thankfully, we have seen the private corporate capex cycle also joining the same theme. Uh, and I do see that the same trend will continue on the corporate capex cycle as well over the next several years, probably most part of the remaining decade, if I can say that. So yeah, so very, very constructive on the industrial capex recovery, and therefore, the industrial stocks and some of the manufacturing stocks, the capital goods, some of the infra companies, the contracting, etc. All those sectors continue to look, very, very attractive. And some of the companies that supply materials that goes towards various forms of industrial capex, like the cables and wires and so on. So there's a whole bunch of those names. Um, and many of these stocks have already done exceedingly well in the last 6 to 9 months, and there could be some pullback there. But I continue to believe that that is the way to go forward from the next 12 months to 24 months perspective, and even longer. So yeah, so that continues to remain, our very high conviction, call housing, industrial capex, recovery plays, etc. that we just spoke about. On the banking and financial side, yes, we started the year preferring NBFCs over banks, and uh, I would say that call has worked out reasonably. Um, and I would actually now like to switch back into the banks, from the NBFCs, because once again, the interest rate environment, the yield environment uh, continues to stay at the elevated level, which I would say is a small negative from the investor sentiment perspective on NBFCs. Banks, I mean, as a sector, has actually underperformed quite a lot. Many of the large banks have not really done well in the last 12 to 18 months. And there are some specific reasons as well. But I think this is the sector that is now looking the most attractive from the valuation standpoint. I would say it's the only sector which is now trading well below its last 10-year average multiples. Most other sectors are above. Um, and it's a large liquid sector. The fundamentals are looking pretty good. So I would say that, yeah, so we would definitely now prefer banks over NBFCs.
And just a question though, Mahesh. Now, for the last 3 months, each of these large banks have had an argument about why that level back then could well be close to the bottom. And then the bottoms have only gone down, right? Be it a valuation argument. In the case of HDFC, somebody made the argument that not only from a local level, but from a global level, it's such a large bank. What engineers the uptick again? Is it a global investor appetite because it's such a large sector that it needs global money to come in and not local money alone will suffice? I mean, what makes the elephant move?
Well, I think one of the reasons why the investors have, shied away, or let's say the banking stocks have not really done that well, is first of all, we have seen uh, the FII numbers have really not been that great over the last 12 months or so. And generally speaking, we've seen that the foreign flows usually sort of favor the banking stocks, but we haven't really seen much of flows from that segment. And the flows that have come in have mostly gone into flows from the FII that have come in have mostly gone into, once again, the industrial and the infrastructure space this time around, and not so much on the banking side. uh, that's a technical reason, but I think the more fundamental reason is that, so one is that there is an expectation that uh, at some point in time the rate cuts will begin globally, also in India. And for a from global investors standpoint, rate cuts are considered to be usually a negative for the banking sector, because all over the world the margins, the NIMs, go down in during the times of interest rates getting cut. Uh, We haven't seen that, really speaking, in India historically, because the Indian banks have managed the NIMs, far better. But now with the interest rate regime and the rules and regulation changing, towards this EBLR, etc. Probability is that there is going to be some reduction in the NIMs over the next 12 months, as and when we begin to see the rates going down. So that's one fundamental concern. Uh, but the other thing is that some of the banks that have enjoyed a huge premium over their peers, or also over the other global banks, and have had a sort of an impeccable track record during the NPL cycle that we saw in the last 10 years, have seen kind of a big derating. And a part of that derating is also attributable to the fact that, as I mentioned, we are into a capex subcycle. uh, the banking sector NPLs have gone down, the provisioning costs have gone down, and I believe that we will continue to be in this benign NPL and provisioning cost kind of an environment. And one doesn't really need to pay a huge premium to get that safety, which was very much essential in the last 10 years. Because I don't think we are in an environment where NPLs are going to go up or provisioning costs are going to go up. So I don't really need to pay that
Mhm.
kind of a premium. And yeah, so there has been that derating in some of those banks, and which I think is also capping the multiples of the other banks as well. So that's the way I put it. But I think now on an overall basis, the multiples are beginning to look pretty attractive. So yes, I mean, you're right that one could have said the same thing 3 months ago as well. But then it's kind of difficult to time the bottom of the market in that sense. But yeah, the sector looks attractive for sure.
Yeah, no one got the bottom, so agree with that. Mahesh, last two questions. One is on the other large sector, which is IT, and you had avoided that. Great call then. Is it time to relook that space because of the valuations in your favor and a new year around the corner, or is it still some time away?
I think we will still stay underweight on that sector, because I mean, we continue to see some disappointments coming through even in the September quarter, as well. So we haven't really seen the end of disappointments, as yet. And yes, the US recession now looks unlikely, and we are looking at positive GDP growth in the US, obviously this year, but the next year as well. But still, the growth rates are going to slide, even if not a recession. So yeah, I would still stay away. And what really I mean, the data point that I'm clearly looking at, even more important than the revenue growth for IT companies, is the hiring, because that's really the key message that comes from the management. And we have been seeing pretty dismal hiring numbers in June quarter, and even more so in the September quarter. So that clearly shows us that even the companies are not really expecting the revenue growth to pick up. So I would like to see the hiring numbers picking up, and that, I mean, I would take that as a key indicator to turn optimistic on the IT side.
Just the other end, when the ERD companies or the product companies in select cases and their numbers, their guidance, or their confidence about business. I mean, LTTS maybe reduced the guidance, but they said, okay, this is the bare minimum we'll do. We'll probably do more. KPITs increase the guidance. Some of the other product companies have done well. The banking product companies, the smaller ones, Nucleus, etc., are doing okay. Is there a dichotomy at play here within that whole tech pack?
Yeah, no, I would say so. So, there is a case to be made for some of the select names, in the sector. ER&D space definitely looks pretty interesting. But yeah, but at the broader sectoral level, as I said, I'll still remain cautious.
Got it. My final question, Mahesh, and I don't now you'll have to excuse me because I don't have the perfect question on this one, but about 12 months ago, 15 months ago, I don't remember when we were doing a conversation, you had said that people will now, at some point of time in the next 24 odd months, start to look at the index valuations X a number of pockets because the index itself will go through change. Companies will have a lot of variance out there. I'm just trying to understand how you think about that issue, particularly how the index could look maybe 1 2 years down the line or 3 years or 5 years down the line, and is there some investor positioning that people need to do so early to kind of account for that?
Yeah, so what I would say, Neeraj, is that the investor community essentially needs to undergo a mindset change, in the sense that what has worked in the last 10 years uh, is not necessarily going to be the same set of stocks and sector that will work in the next 10 years or the next 5 years. And the primary reason is what I said in the beginning, the investment cycle. Over the last 10 years, you know, the GFCF, the fixed capital formation as a share of GDP, was trending just one way, down and down and down. We moved down from almost 35% of GDP to almost to 27, 28% of GDP. During the same 10 years, we saw the NPL crisis, we saw several power, utilities, steel, cement, infra, property companies going bankrupt. And the consumer companies, the safe, high quality names, the expensive names continue to deliver very strong returns. And the investor memories are still geared towards that phenomenon, which has happened in the last 5 years or 10 years. And it's very natural that you tend to go back to the same set of stocks or sectors where you made money in the last 5 or 10 years. But I think the time has come to change that mindset because of this big change that we are talking about. I think the market to some extent has already started doing that, and that's why you see many of the mid caps and the infra names and the cap good names have already done so well. But I do see a big resistance coming from a lot of investors citing valuations. But I think the valuation framework, the valuations definition of what is cheap and what is expensive will get rewritten, like the way it did for many consumer stocks over the last 10 years. I mean, what was considered, I mean, the consumer staple names and even the discretionary names traded at 20 times and 25 times P multiple 10 years ago. And gradually they moved up from 25 times to almost 60, 70 times. Uh, and so much so that now a consumer stock at 50 times is considered cheap, right? Which was not the case 10 years ago. I
Yeah,
think, yeah, I think the market will go through the same set of valuation benchmarks changing for these industrial property, infra, power names over the next 5 to 7 years. And at every point in time, there will be a resistance from the market participants citing valuations. Uh, but I think the valuations will keep on moving up.
got it. Mahesh, lovely talking to you just ahead of the festive season kicking in. Thank you so much, and to you and your team at Jefferies and your family, from all of us at BQ Prime, wishing you a great festive season.
Thank you very much, Neeraj, and wish you the same, and to all your staff and viewers as well.
Thank you so
Happy
much.
Diwali.
Thank you. And viewers, thanks for tuning in.